This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
So you have heard me talk about a somewhat unknown financial product on the show in the past, and that is HEI or HEA, Home Equity Investment or Home Equity Agreement. And this is an industry that is really gaining in popularity. It's been a little cottage industry. It's been around for a while, but few people know about it. I've talked about it on the show before. And the reason I think it is gaining a lot of traction is because, as we've discussed in past episodes, we have 25% of the country that has a mortgage at or below 3%. 65% of the country has a mortgage at or below 4%. And I think somewhere around 80% has a mortgage at or below 5%. They don't want to give that up. They've discovered that underlying mortgage they have has become an incredible asset that cannot be replaced because the cost of money is not very negotiable. It's pretty much a set deal, within a very small range. And that's why there is a way to unlock equity without losing that first mortgage. And this is the lock-in effect. This is why the real estate market has been in sort of this period of stagnation the last few years, because people don't want to give up those cheap mortgages. So here to talk about that today is the founder and CEO of Splitero. They are an HEI company, and that is Michael Gifford. Welcome. How are you?
I'm doing well. Thank you for having me. Yeah, all of that rings true to my ears. We talk about that day in, day out here at Splitero.
Absolutely. So you're coming to us from where I used to live, La Jolla, California, beautiful place. And tell us about Splitero and, kind of the problems it solves.
Yeah, as you kind of spoke about, Splitero is on a mission to help homeowners access the equity in their house without additional debt or new monthly payments. And we deal with a lot of homeowners in that exact scenario, right? They have two assets now. They have that house, and they also have a low rate mortgage, and they're trying to figure out how they access, in most cases, like 50+% of their home value as equity, because they need cash, right? They need cash to pay bills. They want to repair, renovate the property. They don't want to sell. They don't want to move on. And so we're really here to make that as easy as possible and offer an investment product called the HEI, as you mentioned, that is really a newer industry growing rapidly. And it's an alternative that anyone looking to access the cash in their house should consider, as opposed to a reverse mortgage, a cash out refi, a HELOC, or any other of the traditional debt options. We're a non-debt alternative.
Yeah, so that's a really unique selling proposition of the HEI world, is that there are no payments. Basically, what you are doing is you are selling as a homeowner, whether it be owner-occupied or investment property, you are selling a portion of your equity and that future appreciation potential to get cash now. And the reason I like this and want to offer it to you, our listeners, as you've heard me talk about before, is that it would help you get this equity out to buy more investment properties. And that's what we do. So take us through the details of it. When I looked at this originally, started looking at it almost 2 years ago now, Michael, I noticed that unlike a conventional mortgage, there are many other factors. Conventional mortgage, you could just evaluate, if it's a fixed rate mortgage, you could just evaluate what is the LTV, what is the rate, what are the points, what are the costs, boom. What's the term? 30 years probably, right? Simple. But these are more complex, and understanding like how much it will cost you as the homeowner is a more complex equation. How much are you going to have to give up 5 or 10 or 25 years from now? Can you kind of help us understand that and unpack that?
Yeah, I would actually argue that it's easier than your traditional mortgage to understand.
Wow. Okay.
And some of the more tricky reverse mortgage HELOC products out there. Splitero makes it really easy. So we work off a 2 equity multiple. So we'll give you right now, let's just say $1 million house, we give you $100,000. It's 10% of the home value. When you go to repay, you'll pay 20% of the home value. So you know that. That is also the max that you'll ever pay. We also have a homeowner safety cap, which is an equivalent rate of about 19.99% per year. So you play the lesser of the two. If that home's still worth $1 million in a year from now, you'll either pay that 100,000 plus 19.99%, or 20% of that home value, which would be 200,000, whichever is less. And so it makes it really simple for a homeowner to know what they're going to pay in the future. When someone comes to Splitero and applies, they'll also realize that the qualification process is much easier. So there's no income verification, there's no tax returns. We care more about the home and the value of that equity that's in there.
It's an asset-based product.
It's an asset-based product.
Like asset-based loans.
Yeah.
Yeah.
So we're also willing to help, homeowners with as low as a 500 FICO. And just a lot of traditional financial institutions aren't going to work with someone that has a, sub-perfect credit score, and they don't have income that supports additional debt. And so I think it's actually easier qualification for most people to understand.
Oh, I agree. It's easier qualification. I just don't know that it's easier a calculation, right? Fair. And so a lot of these HEI companies, and we've been to the same conference as you and I on this through IMN, and they are sort of self-capping their returns because the regulatory environment on this is, the regulators haven't paid attention to this yet, right? Like you can't put a Dodd-Frank on this, right? And you can't put truth in lending on it necessarily. I don't know. It's like a different kind of product, right? It's not a loan. It's an investment. It's like an equity share deal. So that's the maximum. But let's do an example on that if we can. Okay, so you use the example for round number's sake of a $1 million property. Okay, yep. And most of our listeners they've got $1 million home of their own, or maybe more. But if they're doing their rental properties, their investment properties, those are cheaper. Those are $400,000 properties, right? But let's take $1 million for simplicity's sake. And say that homeowner has a $700,000 mortgage against it. So their current LTV is 70%. Can they get an HEI through Splitero for that?
They can. So we can go up to 75%.
Okay. So you'd give them $50,000 in that example.
Right. And that's a tough example. Your average homeowner comes to us right now with 50 to 55% equity in their house. So really they have $450 on that $1 million house. That's a more typical scenario that works.
Okay, but let's say it's for round numbers. Let's say it's 500,000.
Perfect.
So they own half the house. Yep. They've got a 50% LTV currently. So they've got 500,000 loan, 500,000 in equity, and they come to you. And what is the max you'll give them? $250,000 in that case, right?
That would be the maximum. Yeah.
Okay. Now they sell the property 5 years from now, or they refinance it and they want to take you out and pay you off. How much do they have to pay?
So in that scenario, they could pay either that 19.99 safety cap, right? Depending on what's happened with the HPA of the property, right? The home price appreciation, or they'd have to pay 2x that 25%. So it'd be 50% of the home value, whichever one is less.
Okay, well, let's take an example. Say the home is appreciated, right? Yeah. Say that when they have an exit, a refinance or a sale, or they just have cash and they want to buy you out, right? The house is now worth, just for simplicity, again, it's unlikely that this would happen, but say it's worth $2 million. It's doubled, okay? Yeah. So they've got, on the face of it, just assume their loan is interest only. It's still $500,000 is their first loan balance. And yours is $250 originally.
Yep.
How much do they pay you now?
So it'd still be that 50%. So it'd be $1 million, or $250 at 19.99 annually compounded. So call that, just for rough numbers, 50 grand for the 5 years. So 250 plus 50 grand times 5 would be another 250. So 500,000. So it'd be the lesser of the $1 million or the 500,000, which is 500K in that case.
Okay, let's make sure we make that clear. The lesser of the $1 million. So there's been $1 million in appreciation.
The lesser of 2x the multiple. So in this case would be 25% initial investment. 2x would be 50%.
Right.
Or the investment that we gave them, the $250,000 at 19.99 annually.
Do you have the calculation on the compounded 1999 annually? Because we don't know how many years.
Yeah, we can certainly do it, but we call it roughly 500,000 to 600,000.
Okay. So they pay either $1 million or the cap of that 19.99.
Yep.
Annually. Do you want to elaborate on this at all?
Yeah, no, that's exactly right. So it's a simple equation that we can either do it live right now, or what we provide actually in our disclosures is multiple HPA scenarios, right, going up and down in home value and time frame, so a homeowner can quickly see kind of the dollar and the percentage that they would actually pay on that.
If you want to share your screen and just show that to the viewers.
I don't have the live example in front of me. If you would have prepped me with the live example, I certainly could have ran all the calculations.
Well, send that over to me afterwards if you would, and let's just be able to show this on the screen, because it depends. See, the problem here with this deal, like everybody listening and watching might think, well, that's expensive. Why would I do that? But remember, you didn't make any payments. Right. This is no payments. It's not like a HELOC or a mortgage. It's an investment. You're taking on a partner essentially, and you made no payments to that partner, and you can sit there as long as you want, right? Not really. So let me just explain the term of this when it's due. What they do, and different companies do this differently in your space, but what this company does is they match the maturity of your underlying mortgage. So if you have 10 years left on that, then this is due in 10 years. If you have 28.5 years left on that mortgage, it's due in 28.5 years. You can always get out early and either buy them out through just paying, or refinance and buy them out, or sell the property and buy them out. Okay.
That's correct. Yeah, we do maturity match. So it also kind of simplifies the term, right? There's historically in mortgage spaces, there's a 10-year product, there's a 30-year product. We think it's most eloquent and easiest for the homeowners, and we're just due at the same time that your first mortgage is repaid. And so typically right now, what we see is a lot of people refi in the last 8 to 10 years. So right around on average, we're about a 20-year product right now across the portfolio.
Okay. And that's your commitment, but you think that there will be an exit event before that, I'm sure.
Most time life happens, right? People are going to refi. Maybe when rates come back down, they want to move to a larger house because they have kids, the family's growing. They want to downsize, right? A lot of people are downsizing too. So usually they'll sell or refi or pay us back if they have the cash before that.
Got it. Okay, good. Now let's talk about non-owner occupied. You said 75% LTV, and it's not really LTV. Do you have a new term for that?
We do. We call it OLTV. So it's our option, which is the technical instrument that actually is recorded, plus the loan to value. So OLTV is what we invest plus the LTV of their first mortgage.
Got it. Okay.
Non-owner OC is slightly lower than 75%. That's capped at 65%.
65% on non-owner occupied properties. Okay. So is there a minimum or maximum amount of investment?
We do. Our minimum's 50,000. Our max is 500,000.
Okay. So if they've got a $10 million property and they've got only $5 million against it, you're only going to give them 500,000.
We could, yes. We typically work best sub $4 million. So $10 million property, we don't work with a lot of homeowners with those.
Yeah. Okay. Now let's talk about geography for a moment. I believe you said you were in 13 states.
Correct.
Can you just list those for us?
Yeah. California, Oregon, Washington, Utah, Arizona, Colorado, Nevada, Tennessee, Virginia, Florida, South Carolina, and I'm maybe missing one or two. I think that covers most of them.
Okay. Well, just out of curiosity, why aren't you in all 50 states? Or is it just a matter of time to get there, or are there regulatory hurdles, or what?
Yeah. Ohio, Pennsylvania, Virginia. There we go.
Thank you.
Thank you. So as you kind of mentioned earlier, we're a newer financial product. And so the regulatory environment is unclear. We're doing our best to work with regulators. It's more so state by state now. And so a few states have started to take notice of the industry. As you said, it's growing, right? If you look at this industry, it'll do maybe $3 to $4 billion of origination volume this year compared to a HELOC, which is $250 billion plus, probably growing this year. So it's a newer financial product that's smaller, but growing rapidly. So states are just starting to take notice. We go into a state, we apply for our mortgage licensing, even though it's not a loan or a debt product. And a lot of states, are still trying to figure out what exactly do you do with that application if you're not producing mortgages or a debt-based product. Do you need that license? And then the second part is, how do you protect consumers, right? What disclosures are you giving them? What sort of caps or features of the product do you have in place? And so it's a little bit uncertain right now. There are only a handful of us doing this. We're all very much aligned on consumer protection and making sure that the consumer knows exactly what they're getting into with this product, and it's explained in plain language. And I think that we're all doing our best in an uncertain environment.
Are you sending the consumer statements? Typical mortgage loans, it needs servicing, right? So you have these big servicing companies that are sending you a statement every month. Here's your payment that's due. Here's your impound or escrow account, if you have one, et cetera, et cetera. Here's a notice that you need to renew your insurance, things like that. Are you doing that? HEI doesn't really have to do this because there's no payments due.
We do still service because there's a lot of important data that we want to know about, right? If someone is, say, delinquent on their first, if they have any other liens or anything that's been recorded, right? We're still monitoring to make sure that everything is going well for the homeowner. When it's not, we step in and say, hey, how can we help? What's going on? What's the situation? We do send quarterly statements. So that quarterly statement's a little bit different than a mortgage statement because there's nothing to be paid, but we update property values. We talk about other opportunities, what's going on in their market. We bring some consumer education in that. So we do send quarterly statements, and we do service this product as you would a traditional mortgage without the payment.
Without the what? Without the payment?
Yeah, without collecting payments. So
yeah, makes sense. Okay, good. It sounds like the industry's not even sure if they need a mortgage license, but it sounds like you're getting one sort of just in case, right?
We do. So my background is in loans and renovation and fixing and flipping properties. And so we take a pretty conservative approach, including applying for a license. It doesn't mean that all states are going to grant them, right? Some, our licensing application just sits there because they don't really know what to do with the product yet. Some grant them right away and say, hey, thanks for applying, and please protect consumers the best you can in the uncertain environment.
Yeah. Okay. What else should people know?
I think Splitero is pretty uniquely positioned with our brokerage as well. So homeowners that received an HEI from us, when they're ready to sell, our brokerage is ready to help them do that. We're aligned with an interest that no other broker or agent is going to have, since we're invested in the home alongside the homeowner. And we're expanding, right? We're growing as quickly as possible. This is a space that if someone is in distress and they need cash now, we can help in as little as 9 days. If they're looking at a reverse or a HELOC or any other closed-end second, or even just a traditional cash out refi, they should look at Splitero and the product. I think it makes a lot of sense for a lot of homeowners. It's time that people that have equity in their house quit thinking about debt-only options, right? Historically, we've only given more debt to homeowners than consumers. It's just not the right option when there's an equity investment out there.
In terms of the mechanics, basically, you're monitoring the property, and say the property was listed for sale. I don't know if you know that, but you'll know.
We do.
With the title cert. Oh, you do know if it's listed even, right? So you're monitoring that. So they listed for sale, they sell it. And what do you do? Like exercise your option? There's two ways, by the way, HEI companies are doing this in terms of the legal mechanics of it. Some are doing what's called a forward sales contract, and most of them seem like they're doing an option, basically, right? So what do you do? Like exercise your option the day before closing or something?
You don't, yeah, I mean, it'd be technically like an instant exercise. So it's all in the same closing. It's the same as you would repaying any other, lien that's on title. Traditionally, most of these products are going to be kind of, call it 95% in second position behind a first mortgage. Some people will do third lien positions, and also there's very few, but there are first lien positions as well. And so, technically you're exercising right away, but it's all simultaneously done through closing, either escrow or title, depending on the state you're in.
Yeah, interesting. And what's your average size deal? Did you mention that already?
Yeah, the industry really sits kind of between 100 and 125,000 is the average unit. Industry wide, ours is the same.
Yeah. And do you have clients that do this with their personal residence, and then they also have rental properties, and then they also do HEI on those?
We do, yeah. It's a newer financial product, so people want to get up to speed, understand what's going on. We have all sorts of scenarios where they'll try us out for a smaller amount and say, hey, this is great, and come back for a larger amount, or say, this worked on my primary. I have a rental, or they'll try down the rental and then want to go back to their primary. So we see all of that because people do realize, it's a unique opportunity for us to give someone up to $500,000 without a monthly payment. And what that can actually do to somebody's financial picture is incredible. We hear about folks all the time that are, solving all their debt concerns, maybe even repaying their first lien on their mortgage, we see, so they don't have any monthly payment on their house. Starting new businesses, right? People are using the funds to start businesses. So,
or buy more properties.
Yeah, buy more properties. There's a lot of use cases for this that are just, incredible because of the feature of no monthly payment on it.
Mm-hmm. Yeah, this is definitely a world like the lending world or like any part of the Wall Street world that I would, or institutional investors like Invitation Homes, et cetera, right? I would call this the smart money, right? Because these companies like yours have financial engineers, they really have analyzed the market, they've analyzed the product, they've analyzed the financial aspect. And, would it be fair to say that if you're in the HEI business, that you're bullish on real estate prices?
I think bullish on U.S. Real estate in general, right? Not even just near-term prices, but in general. I mean, it's a large asset class. You're talking about a market that right now is 35 trillion-ish, depending on, where you're getting your data from. But yeah, we're bullish on not only the U.S. real estate market, but also the home ownership that is in that and giving them another option.
Yeah. When I talk to some of the HEI companies, they say they'll literally offer an HEI product to that homeowner the day after closing. So a homeowner can buy a property, say they put 20% down, and that's not going to do it, right? Because will you go on appraised value or sales price? I'm curious.
It depends on the scenario. Either we pull our own valuations in, though, in almost every case.
Right, but what do you not lend on? Well, I'm comparing it to like a refinance, right? Because if you wanted a cash out refi, the day after closing, they wouldn't give it to you on the value. Yep. They'd only give it to you on the purchase price, unless you wait and season about 6 months or 12 months, right? What do you do? Have you ever done an HEI where it's very shortly after they acquired the property?
We have done a few. I think they're pretty rare. Most people aren't in that situation, but we have done a few, and we can help those homeowners as well.
Yeah.
We pull our own valuations in regardless.
Got it. And I'm sure you're probably only willing to do the HEI LTV or OLTV based on the purchase price, I'm guessing.
Within a short seasoning period,
yeah. Yeah, okay. What about the concern of the due on sale clause, though? Because, that first lender that gave them the loan, right? Wouldn't they object to that they yank some equity out right after they close?
I wouldn't say that'd be a due on sale clause because we're recording behind them. So usually there's not much interaction with the first lender. The lenders, I guess, LTV is changing, but that's why there's lien position, right? They can still foreclose from first lien position. And if they're comfortable in their LTV, we're comfortable with our OLTV right behind them.
If someone does get into distress, have you had to go like a second lender would? Have you had to go and pay the first so you can control that process, or have you not been in that situation yet?
We have, and we step in, and that's kind of the other side of Splitero Homes, right? Our brokerage is able to step in and say, hey, let's understand the situation. Maybe it's best to sell the property. If they don't want to sell the property, then let's talk about the foreclosure. Can we cure it, right? Is there additional capital we can extend to cure the default? Or if it does go to foreclosure, how can we help that homeowner out? And, what are the options? A lot of times, we might choose to bid to protect, right? If we want to help that situation, we can bid to protect the property.
If you mean bid at the foreclosure sale?
Bid at the foreclosure sale, but there's a lot of preventative stuff that we can do ahead of time because we're so low, leverage on these assets, right? The amount of equity that someone has, it's not like it was a long time ago where people are pushing 85-90% of the home value. You're talking
right. No, there's tons of equity right now. I mean, 40% of the country has no mortgage at all. The estimates I'm reading are that, Americans have a record amount of equity right now. And I think the last one I saw was $43 trillion in equity. And that means the value of the real estate market is exceeding 50 trillion for sure. That might be mixed in with commercial or condos and single, this stuff's complicated, folks. When you look at data, you really got to peel back the layers of the onion to understand it.
You do.
It's
but More equity gives more optionality to that homeowner in a distress scenario. So there are a lot of different tools and levers that we can pull to try to help someone out.
Yeah, yeah. One question, you keep mentioning your brokerage. I mean, is your brokerage really large or something? Because how can you be in all these markets, when you say like a state like California with 40 million people, you'll loan anywhere in the state, right? But how can you cover brokerage in all those markets?
Yeah, not loans. So we don't do any loans. We will make investments in most of the state. We do a lot better in larger MSAs, right? So think your larger MSAs, more suburban, and urban neighborhoods than your really rural properties, right? Those are difficult for us. And the brokerage does. We have coverage for most of our homeowners. We're not in every single state yet, but the brokerage is growing and expanding, and really, our interests align with these homeowners. We want to make sure they maximize the value. If they choose to use us, they don't have to use Splitero Homes by any means, but we're there to help.
Interesting. And yet, I don't know if any other HEI has a brokerage component. It's just interesting that you're doing that,
Yeah, I appreciate that. We think it's a huge value prop for our homeowners. So, and we enjoy it.
Interesting. Before we go, let's get a little viewpoint on the size of the industry, the size of your company, like how many of these deals are happening every year or every month, and how many contracts, have been recorded already in the country, like how big is this?
Yeah.
Or small?
Yeah, historically, there's really kind of 4 or 5 players. One has kind of switched from Unison was the original player, right? And they've switched to a different product right now than the HEI. But the 4 of us that are there will do, like I said earlier, 3 to 4 billion of origination volume combined this year and growing. There's a lot of interest from not only homeowners as to alternatives to access the equity in their home, but also the institutional markets have really come around to this as an investment vehicle, which really helps grow the space in the industry. Any large financial product like this needs a lot of capital on the other end of the spectrum, and the capital markets has really turned in the last couple of years to support the industry and help grow the industry, as I'm sure you've seen at all the conferences that you've attended.
Yeah, absolutely. And we've talked a lot about the age of this, and we've sort of given the misnomer that this is a new product. It's not new. New. For example, Unison, the big player you mentioned, was founded in 2004.
Yeah.
Okay, so that's 21 years ago. It's not like this hasn't been around. It just sort of never got big. And I think the reason it's getting so big right now is back to the lock-in effect of people not wanting to give up their low-rate mortgages. In the past, they would just refi, but now they don't want to refi because they don't want to lose that great mortgage they have. So.
Yeah, I think it's two-sided. I think that you have real estate values have remained steady and stable and grown. You have people with low rate mortgages that they don't want to take out because who knows if we're ever going to get back down to the 3% range or not. And then you have on the other end of that, the capital markets and the credit that a lot of these larger institutions have done supporting the asset class early on. And now we have rated securitizations that are happening multiple times a year, right? And that proves that the industry at whole is here to stay. The product is going to grow, and this is an alternative product that most homeowners should look at. And so it's kind of two-sided, gaining a ton of support and momentum really in the last handful of years, but the space has been around for much longer than that.
Yeah, I agree. You mentioned investment in these products, and our listeners are investors. Can they invest with you? I know some of these other companies have their own funds and they allow people to invest in the fund. And I don't know of any of the, major players that are doing this, but I think it's a, thing to do is they could buy the contracts one by one, just like they buy a note on the secondary market, right? Do you have that option?
We don't offer that yet. There are, I would say, when you talk about a class that's, let's just call it 35 to 40 trillion, whatever the number actually is. There are a lot of folks trying to figure out how they can work with that. And so there, I think over the next couple of years, you'll see different vehicles where people are, say, putting this on a coin, right? And they're able to invest in a coin that's backed by HEIs. We're seeing that often.
Oh, in other words, a crypto, a blockchain.
Coin. Yeah. So they can actually invest in that coin, which is backed by properties in HEI, either a single or multiple. There's a lot of different activity going on there. And then, I think investment funds are starting as well that invest strictly in HEI. And so they can't do it directly through Splitero right now, but there are a lot of alternative ways to get involved.
Yeah. So you're basically getting your capital from, various sources that are just like institutional sources, I'm guessing, right?
Yep. Large institutional investors. You think about the size of these funds, hundreds of billions of dollars, and this is a small part of their portfolio right now, but we're looking to grow that as much as possible.
Mm-hmm. Yeah, very interesting. Any questions I didn't ask you? Anything else you want to share? I mean, we didn't talk about, closing costs, and you did mention the time frame that you could do them quickly, but I'm assuming the average closing is like 45 days, right?
No, we're significantly faster than that. So we focus on speed and velocity. A lot of people need these funds when they come to us. We can go as fast as 9 days. We're going to be much faster than most financial institutions for sure. I think.
Well, the other HEIs, they say 30 to 60 days, which I kind of can't believe. I thought, why aren't they faster? This should be a faster product than a traditional mortgage.
We're across the portfolio. We're much faster than 30 days. And it's something that we really focus on. It should be faster. There shouldn't be that lag. I will say that a lot of the time is spent, with homeowners gathering docs or any sort of title curative work that goes into it. And so the faster someone can, get us what we need, the faster that we can get them the funds that they need.
Why are you faster than the others? Or do you just aim to be faster, or is there some method or
I think we built a pretty good platform that can process things quickly. Our team is certainly aiming to be fast as possible. We know that somebody comes in and if they're waiting for $150,000, it's life-changing money, and so we're trying to get that to them as quickly as possible while still dotting all our I's and crossing the T's.
Yeah, cool. Good. Okay, well, the question was, anything else you want to say?
No, I don't think so. This has been great. Thank you for having me on.
All right, Michael Gifford, thanks for joining us. Appreciate all the insights.
Thank you. Yeah, feel free to apply at splitero.com.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.